All right, the markets are open this morning, and it looks like we are up so far, but it's only been a minute. But we're going to keep an eye on the Dow and the rest of the global economy amid this banking turmoil. Let's dig right into it. Here to discuss is Javier David. He's the managing editor for business and markets at Axios. And, of course, he's a CBS News contributor. All right, so, Javier, the Fed, as you know, is meeting this week. They will likely approve another interest rate hike. Talking about the banking turmoil, I mean, if you compound that with this hike, what does it mean for the economy, fears of a recession? But even before that, I mean, for people who are wondering out there, is banking in the United States secure? What's the answer?
The answer is yes. What we're seeing unfold in the markets really is a debate about whether price stability is more important than financial stability. The markets are sending a signal that investors are very nervous, but thus far we haven't seen depositors move all of their money either under their mattresses or to other banks, but there's some signs that they're shifting from smaller and medium-sized banks to larger banks that are considered sort of fortress-style bulge brackets like the JPMs and the Bank of Americas and so forth. So they want their money to be secure, but there's no run on banks. What we're seeing now is a lot of sort of mayhem and instability associated with people really nervous that this is a rerun of 2008.
All right, so let's talk about what's been happening overseas. Banking giant UBS has agreed to purchase Swiss rival Credit Suisse for over $3 billion. This is a deal apparently negotiated with the Swiss government. What can you tell us about it? Why is it significant?
Yeah, UBS was sort of a logical fit to digest Credit Suisse. There's been a lot of speculation over the sense of years that they might do that. But if ever there was the definition of a shotgun marriage, this is it. Swiss regulators really played the role of the stern parent. They strong-armed both sides into this hastily arranged deal. It's really designed to corral contagion fears and restore confidence. Credit Suisse is literally too big to fail, but they're also too badly managed to persist as an independent company. This is, even with nearly 200 years behind it, they've sort of lurched from crisis to crisis. These have been years of cascading scandals, poor results. It all finally caught up to them last week, primarily because this crisis that started with Silicon Valley Bank really has become a whole big sort of dark cloud hanging over the banking sector. Investors were not trying to hear any more sob stories from Credit Suisse. They're really in an environment where everyone is concerned about the banking sector. Credit Suisse's timing couldn't have been worse.
All right, let's talk about the FDIC announcement yesterday night that it sold a huge chunk of failed Signature Bank deposits to Flagstar Bank. Explain why this is important and what it signals to other banks.
Yeah, and this is one of those things where we've been trying to make the distinction, those of us in the financial press, about sort of idiosyncratic things that were very isolated to very specific financial industries or financial institutions. Signature had a couple of things going for it. They had a large crypto portfolio. They were trying to be crypto players. When all of the drama surrounding SVB started, they got caught in the backlash. And ultimately, they had a number of large outflows of deposits. So in Signature Bank's case, this is actually an encouraging development because they've found a buyer. And even though it was under duress, we're still, as we still sit here almost 2 weeks later, Silicon Valley Bank still hasn't found a partner. So it's encouraging that someone was at least willing to pony up money to sort of secure the deposits or secure the future of this bank, as opposed to Silicon Valley Bank, which is still very much an open question.
So speaking of Silicon Valley Bank, initially when the story broke, it just seemed like they just had sort of a series of bad luck things that all sort of came to a head at the same time. But now we're learning that they were actually under review by federal, regulators because of some of the practices. What do we know about what the bank was up to? Was it really sort of risky behavior? And if the government was watching closely, why didn't they do anything?
Yeah, I mean, we don't get the sense, at least thus far, that anything that happened or transpired at this particular bank was criminal, but it's very clear, and sadly, we always find these things out after the fact, that there was a lot of bad management decisions, people sort of taking certain things for granted. In Silicon Valley Bank's case, they had a portfolio of government securities, which are technically considered safe. But in an environment where interest rates are rising quickly, you are, as a financial institution, one of your primary obligations is to kind of predict the future and predict it accurately, but also prepare for the unexpected. And in Silicon Valley Bank's case, it's clear that they did not. And it looks like they were getting some sort of warning from the powers that be and told them, hey, you guys need to fix this, or you need to really pay closer attention to it. And when things are going great, people have a bad tendency to sort of write off what they can get away with. And in this case, they overestimated their ability to manage the situation.
Javier David, always great talking to you. Thank you.
Thanks, guys.